Good afternoon, everybody. Welcome to this webinar in the context of the CEPR Research Policy Network on European Financial Architecture. I'm delighted to have experts here from the ECB to present parts of the Financial Stability Review. The Financial Stability Review of the ECB is a publication that appears twice a year. It's full of information about the state of the euro area financial sector, and in particular, at the end, it always has special features where we can delve in more detail into specific topics. And today we have the authors from two of those special features here to present their analysis. We have Cosimo Pancaro, Jaspal Singh, and Balázs Zsámboki, and they present the special feature on geopolitical risk, with which we will start. Cosimo is going to present that, and then later on we'll have the special feature on AI issues that will be presented by Jaspal and Balázs. So with that, the ground rules are that I will monitor the Q&A. So if you have any questions, please put them there. If they are more general questions, I would suggest that we discuss them after the presentations. If there is an urgent need to clarify anything, put that also in the Q&A, and I will pass on your questions to the presenters. We have prepared, I think, 2 times 15-minute presentations, so there will be plenty of room for discussions with the authors. And with that, welcome Jaspal, Cosimo, Balázs. It's great to see you, and Cosimo starts with the special feature on geopolitical risk. Over to you, Cosimo.
Yeah, thank you, Florian, and good afternoon to everyone. So as said, today I'm going to present our special feature on geopolitical risk, which is actually entitled Turbulent Times, Geopolitical Risk and its Impact on Euro Area Financial Stability. This special feature, as said, was published on the Financial Stability Review that came out a few days ago. So first, let me give you some info about the outline of the presentation. I'm going to give first some background. Then I'm going to briefly provide a conceptual overview about the transmission channels through which geopolitical risk can affect financial stability. And then I'm going to provide some empirical evidence about the potential implication that geopolitical risk can have on euro area non-banks and banks. And finally, some policy conclusions. So, the background is the following. As everyone by now knows, lately there has been an increase in geopolitical risk and geopolitical instability, as testified by the latest events, like the conflicts in the Middle East and the tensions between China and the US over Taiwan, or the Russian invasion of Ukraine. And these geopolitical tensions can be a threat for the global economy and financial stability. So basically, understanding the geopolitical risk effects on the euro area financial sector is fundamental, I would say, to ensure the resilience of financial institutions. Let me say one key point here is that in this analysis, geopolitical risk is defined as the threat, realization and escalation of adverse events associated with wars, terrorism, and tensions among states. And this definition follows closely the definition used also by Caldara Iacoviello 2022, which introduced a GPR index that we will use largely in the analysis. Then, as said, just let me introduce the topic, providing a conceptual overview about the possible transmission channels. So, as said, a geopolitical risk can affect the overall economy, both through the financial side and the real side. In general, we would expect that adverse geopolitical events can lead to a change or to shifts in market sentiment and to an increase in uncertainty that could expose existing vulnerabilities, both in financial markets and financial institutions. Geopolitical risk can, as said, affect the financial dimensions of the financial context through implication through asset prices and market volatility, just to say 2 variables. But also then it can feed through the real economy leading to a slowdown of economic growth, to an increase in inflation, and overall to a revision of consumption and investment plans. So these overall, these financial dimensions and the real dimension can then interact, and there can arise feedback loop, which can have further implications, let's say, for banks and non-banks. So then the next slides will be exactly about this, trying to provide some analysis about the potential implications for euro area banks and non-banks. So first with non-banks. So let's say non-banks are in a way first in the line to potentially feel geopolitical stress. And here what we claim with a chart on the left-hand side is that actually investment funds, euro area investment funds, are especially exposed to geopolitical risk through their holdings of equity and corporate bonds. And this can be seen in this chart how. So basically what the different bars report are the holdings in amounts, so in trillions, of different sectors in the euro area. The investment funds are the bar on the right-hand side. And basically here what we report as well is also the categorization of these equity and corporate bonds by degree of exposure to geopolitical risk. And basically where let's say the darker red components of the bar are the holdings which result more exposed to geopolitical risk, because those sectors are more exposed to geopolitical risk. And then the yellow dot there is kind of the overall share, the percentage share of equity and corporate bond over total equity and corporate bond portfolio, which are highly exposed to geopolitical risk. As you can see, overall, the investment funds hold about 8 trillions of all these equity and corporate bonds, and the share of the, let's say, highly exposed asset is about 10%, so high concentration of risk in this sector. And this implies that in presence of geopolitical risk or materialization of geopolitical risk, investment funds are especially exposed to market risk, so to valuation losses, but also to credit risk. Then on the right-hand side, we try to analyze the impact, the potential impact of a geopolitical risk shock on equity fund returns and flows. And what we see here, the dashed line, is that overall there is a decline in equity fund returns, and consistently, let's say, also sizable and persistent outflows from the equity funds. However, what it can be observed, and these are the other solid lines, you can see that the flows are different across different type of equity funds. For example, you have like above the zero line, let's say the solid green line, the flows for, let's say, the funds that invest especially in energy, like gas and petroleum. And here we observe some inflows. While, for example, the equity funds that invest especially in financials and industrials, they exhibit larger outflows. So this reflecting the fact that different sectors have a different degree of exposure to geopolitical risk. Moving on, still looking at the non-bank financial sector, we see here on the left-hand side that a geopolitical risk shock has a positive impact, let's say, on euro area corporate bond spreads, both on impact and over the short term, like over after 6 months, let's say. And this, we take this as indicating that after a geopolitical risk shock, there is a decline in the risk appetite of investor. And this is reflected then in the chart in the right-hand side, where we can see that corporate bond funds, so the blue bars, let's say, the blue negative bars in the chart, corporate bond funds basically experience, after a geopolitical risk shock, persistent and sizable outflows. And this also reflects the fact, as reported by the solid lines, that corporate bond fund returns, but also sovereign bond fund returns, decline. What is interesting to notice, though, is that on the other side, sovereign bond fund flows, despite the falling returns, they still exhibit or record inflows, kind of an evidence that we read as a flight to safety. At the same time, let me mention one last point on this slide, going back to the chart on the left-hand side, where we see that, let's say, the responses of the spread between the Italian, the yields on the long-term Italian bonds and the yields on the German bonds, so an indicator of kind of fragmentation. So basically, these responses are not significant, indicating that we don't find evidence in favor of a potential effect of geopolitical risk shock leading to additional fragmentation.
Cosimo,
Yes,
there was just a clarifying question on the previous slide in the Q&A, whether non-banks...
Sorry, I cannot see the Q&A because I don't see, I just see the slides.
Yeah. So that's why there was just a clarifying question that when you write non-banks, does this exclusively mean non-bank financial institutions?
So you refer to these slides here?
Yeah, just the non-banks. What exactly is in the non-banks?
So I mean, non-banks, as you know, like basically the non-bank sector is really rich and complex. There are different type of institutions there, no? So it depends a little bit on the type of chart and type of results that we report. But for example, here in the chart on the left, I spoke especially about investment funds, and then we have here the second bar, like the insurance corporation and pension funds. And then, for example, here we have equity funds, and here we look especially to corporate bond funds and to sovereign bond funds. So in general, it's a very rich, let's say, sector, and actually also quite heterogeneous within the sector. So it depends very much on which specific result we look at.
Thanks a lot for clarifying.
Yeah. Okay, but then moving to banks. So basically what we find in the special feature is also that, let's say, geopolitical risk can have adverse implication for banks. But actually what also we find and we realized is that the actual exposure or the actual vulnerability of banks to geopolitical risk is rather heterogeneous across the euro area. And that's basically the reason why we built a kind of bank exposure weighted geopolitical risk index. So which means that relying on the initial index provided by Caldara and Iacoviello, we used actually the country level version of this index. We extended to all the euro area countries, we standardized it, and then we weighted by the actual share of exposures to the different countries where the banks have operations. And in this way, we built a specific bank level exposure weighted geopolitical risk index that is reported here in the chart on the left-hand side, where we report the distribution and the average. And basically what you can see is that over time, there is quite some variability. And as expected, let's say the index peaked at the start of the Russian invasion of Ukraine. And this is also reflected in the chart on the right-hand side, where basically we actually report, like in a sense, the cross-section at Q1 2022, so at the same time of the Russian invasion. And we can see that geopolitical risk, so banks that were most exposed to geopolitical risk turn out to be the banks established in countries which were more more geographically close to the center of the crisis, so closer to the Russian to Ukraine. Moving forward, then what we did is that we used this variable, so this bank level index that we built, as a key variable of interest in a panel regression setting. So we included this variable on the right-hand side as our variable of interest. And then on the left-hand side, we tried different dependent variables, measuring different types of, taking into account different types of metrics that are relevant for banks. So here we report CDS spreads, stock prices, and cost of funding, where cost of funding is measured by bond yields. And what we found is that indeed, it appears that there is kind of a relationship, a significant relationship between this bank level geopolitical risk index and CDS spreads and these variables that I just mentioned. And especially what we find is that geopolitical risk events can have an adverse impact on CDS spreads and stock prices. and might also lead to an increase in bond yields, bank bond yields. And especially these results, they were driven by banks which were, so banks that were relatively more weakly capitalized and with lower profitability, indicating basically the fact that investors, in presence of this type of events, they tend to disinvest and to ask for higher returns from banks that are seen as less resilient. And then, I mean, final piece, let's say, of analysis for which we report the results here is kind of a similar exercise as just mentioned before in the previous slide, but here we took into account as key dependent variables, let's say, the cost of risk and the return on assets. And what we find is that indeed, so the macroeconomic effects of geopolitical risk, so kind of a deterioration in the macroeconomic environment that is led by the geopolitical risk, has an impact on banks' provisioning. So meaning that in presence of geopolitical risk events, banks might need to raise their own level of provisioning. And this was, evidence shows that this was especially driven by smaller banks. So banks that are more domestically oriented, let's say, generally, and then basically they have less capacity to diversify risk away through international activities. And then basically that also return on assets, so banks' profitability is negatively related, so it's negatively affected by the geopolitical risk events. And in this case, this was especially driven from smaller banks and weakly capitalized banks. And again, the idea here, the rationalization of the intuition was that higher funding costs, potentially weaker lending, and the deterioration of asset quality associated with geopolitical risk could lead to a fall of bank profitability. And finally, just a few policy considerations. So basically, just to say that overall, geopolitical risk might have negative implications for banks and non-banks. However, we also believe that geopolitical risk shocks alone are unlikely to cause a systemic crisis, but there might be a trigger for systemic distress if they interact with pre-existing vulnerabilities. And then this is a key dimension, a key risk that needs to be taken into account both by central banks or policy authorities, but also by financial institutions. It's crucial that it needs to be continuously monitored to assess the actual exposures and actual vulnerability to this type of risk, and also to have in place, let's say, the necessary either policies or contingency plans to potentially address the materialization of the risk. And with this, I'm done for the presentation. I'll be open to take questions.
Thanks a lot, Cosimo. We already have a question in the Q&A. Luca Branco asks, could you tell a bit more what's in the GPR index? I understood it would also consider the effects of geopolitical risks on commodities and financial assets. Does it account, for example, political turmoil in South American oil-producing countries or US-China trade war?
Yeah, okay. So, I mean, so basically, I mean, the geopolitical risk index that was originally, as I said, introduced by Caldara and Iacoviello in a AER paper in 2022, captures this type of events. So these events that are defined in this bullet here, so threat, realization, escalation of adverse events associated with wars, terrorism, and tensions among states. So that's the intention of the index. And then basically, let me say a few more words about this index, because actually it's a very important question and it's good to clarify. So basically, I mean, the index is computed through using some kind of language analysis, and in particular, like analyzing newspaper articles published in a number of newspapers in the Anglo-Saxon world, so newspapers covering especially Canadian, UK, and US newspapers. And basically, it depends on number of articles that talk about geopolitical risk index over the total number of articles over a month. That's kind of the way the index is computed. Then the index also offer, there are different types of index of the same index. So meaning that there is a global geopolitical risk index, and then there are country level indexes. So when we did this part of the analysis covering the non-banks, we use the global geopolitical risk index, while basically when we moved to the, as I said, when we moved here to the banks, to build this kind of extension of the index, so this bank level index, we use the country level type of specific indexes for the euro area countries. And actually, since these country level indexes were not available for all the euro area countries, we kind of replicating the same analysis or the same methodology, we extended to all the other euro area countries such that we could have a more comprehensive coverage. So this would be, in a nutshell, let's say, what the index is about.
Yes, so thanks a lot. I actually had a similar question to follow up on that theme. So when you do a local, let's say, index for Germany,
yeah,
are you then looking at German newspapers or English newspapers where Germany appears?
Yeah, exactly, yes.
Okay.
Yes.
Okay, so it's things happening in Germany.
Yes.
That would then, okay.
No, actually, this is a very good question. Actually, it's good that you bring it up because it's nice to mention also that actually this is a little bit of a caveat of a regional index, no? Because in a way, it might be somehow biased by the type of news that are covered by the Anglo-Saxon media. And actually, what is nice to mention, and that some colleagues at the Bundesbank, actually recently they have a new paper out where basically they kind of address this type of caveat and following a similar methodology, but they recompute the index using the national type of media information. And they find that indeed there is a little bit of a deviation. I mean, there is some deviation in a way between the index computed using the, like, let's say, the Anglo-Saxon media and the national media, because obviously the perceptions across countries are different.
Thanks a lot. I just quickly looked for it where I could find it. If someone has this as a link, we can still put it maybe in the chat for everyone later on. If not, then we'll...
Yeah, I mean, I can give it to you, like, as soon as I'm done, I will post it.
Very good.
I know that paper very well, actually. I mean, very well, but I mean, I went through, I can post it.
Okay, super. In the meantime, we also had a question from Marcel Magnus. The question is the reaction to geopolitical risk driven by the level of capitalization in absolute terms or driven by the capital headroom, i.e., to the extent to which actual capital exceeds or becomes close to the level required by supervisors?
Yeah, so good question as well. And so basically what we do here, actually, for example, in this analysis here, no, we don't consider a headroom. But actually, the variable that we include as a metric to capture solvency, or let's say capitalization, is more kind of a leverage ratio. So like equity over total asset.
Okay, but you could easily redo the analysis with...
No, I mean, easily, yes. I mean, easily. It can be redone, yes. Could be redone. But we did not do it.
By the way, just if you go on to the next slide, I had a question also on capitalization. You had...
Here?
Yes. So the left-hand side chart, it says that high capitalization banks have a higher cost of risk.
No, but I mean, sorry, just one thing I did not mention probably. What is important to notice here is that only the solid bars are significant. The shaded one are not significant. The solid bars are significant at 10%, at least at 10%. Okay. These bars here are not significant.
I understand. In the while we're still maybe waiting for questions, I was wondering the following. So also in case of your country exposures and for the euro area, isn't the one thing that that I haven't heard you talk a lot is energy, right? I mean, a lot of the geopolitical risk is associated with inputs to production, rare inputs, whether it be commodities, but particular energy, gas, and oil. To what extent does the analysis address this, or would it warrant another way of looking at the problem? Because I could imagine that Germany was very exposed to the war in Ukraine, not because the banks were investing in the Ukraine, unlike, let's say, the Austrian banks, but because it was heavily dependent on oil and gas from Russia.
Yeah, I mean, okay, maybe two things you can notice here. One thing is like, let's say, maybe yeah, what you said indeed, I mean, here you see that Germany actually is not as dark as the Baltics or as Finland, but is kind of relatively, it seems that it's relatively more exposed, no? So to some extent, even if we don't control directly in this part of the analysis, let's say for oil or gas prices, it seems that the index still kind of captures some of that. But then, I mean, where this kind of dimension is more kind of taken into consideration in a sense is what I mentioned here. So basically meaning that indeed here you can see like this solid line, these are the flows after a geopolitical risk shock of energy equity fund. And you can see that indeed there is differently from the most of the other type of equity funds, there is an inflow. And that's why, because basically, I mean, this type of funds which invest more, for example, in type of related gas and oil type of investments, they might either benefit or not being harmed as bad as other sectors, no? So definitely is a crucial element. And then, I mean, let me see, because here I think I might have another slide that in the annex that I didn't show it in the presentation because of in the interest of time. But here, as you see here, we report also inputs responses functions for other macro financial variables. And what we have here is that oil price volatility. So basically, there is definitely some type of increase in oil price volatility after, again, a geopolitical risk shock. So, I mean, just to summarize, let's say, despite the analysis did not fully focus, let's say, on the point that you raised, obviously it's a dimension that we took into consideration, and it's a crucial one, no? It's a crucial one. And actually, also, as you can see it here, you see that in case, this is just qualitative, no? This is just descriptive evidence, and we report just the evolution of the Caldara-Jacobiello index over time, so the yellow line, and then the price of the Brent over time for very long time series. And you can see that for some geopolitical events, for example, the 70 oil shock, there was a clear relationship between the oil price and the geopolitical risk. I mean, at the same time, also, what we noticed doing analysis is that this does not always hold. It's not always the case. It depends on the type of event. It depends on the type of geopolitical risk event.
Okay, thanks a lot. We are at the halftime of our hour. So thanks, Cosimo, for this important analysis of how the world is changing in this aspect. And now we move on to our second special feature, which deals with yet another game-changing developments, which is the rise of artificial intelligence. And by the way, before before this presentation, I had ChatGPT summarize the main findings of your special features, and let's see whether this lines up very well with what you're going to say. So this stuff is really in everybody's mind. So I don't know who's starting, Jaspal or Balázs?
I will start. Yeah.
Okay.
Just give me.
Oh, we don't see slides right now, right? So somehow we don't see slides.
Yeah, just give me 1 second. I think now it should work.
Yes.
Yes.
So thank you for the invitation. Thanks, Florian. And I really hope that the AI will work for you. But before cross-checking your results and our presentation, let me just say a few words or some introductory words, and then I will hand it over to Jaspal to say a bit more about the special features. So this is a joint project with colleagues, Georg Leitner, Anton van der Kraai, Jaspal, Singh, and myself. We are all from the DGMF. This is the macroprudential policy and financial stability area of the ECB. And we started to work on this project about a year or 2 years ago. And if you go to the next slide, it provides some background why we thought that this is an interesting project or topic. We have a couple of charts here for you, and I would like to start with this just to mention that, for example, on the left-hand chart, you can see the number of AI professionals that has been increasing quite substantially in the last year, both in Europe and in the United States. And on the right-hand side, you will see the number of patents in the AI industry, and that has also increased quite substantially in the last couple of years. So this is not a new topic. AI has been with us for a while, but what really was a game changer, I think, was the publication of the ChatGPT, and that this became the AI model and instrument became widely available to the general public. So, and that also created a lot of attention, what AI is and what potential risk it may bring to the financial system. And on the left-hand chart, you see these lines, the Google search trend, generative AI, and AI finance, basically skyrocketed after 2022. So that also captured our attention, and we wanted to look into this issue more in detail and also to analyze a bit the benefits and the challenges that this may bring. Now, we are not the first one who analyzed this. Also, international bodies like the FSB, the Financial Stability Board, the Bank of International Settlements, the BIS, also the IMF, published several papers, also the academia, central banks. But what we felt is that those papers either are not really specifically focusing on the banking system or the financial system or systemic risk in general, or if they do so, there's no conceptual framework that could provide us with a good basis for analyzing this issue. So we believe that the added value of this special feature is that we develop conceptual framework for assessing the implications for the financial system. Yeah. And second, we start to discuss these implications both at the level of individual institutions and at the systemic level. Okay, so this is what we focus on. We do not claim that this is a final classification. We know that we are at the beginning of a long journey, but I hope that this will have either us at the ECB when we conduct our analytical work, and also the wider professional or those who are interested in financial stability issues to structure a bit your thinking about the AI-related risks. And with this, I hand it over to Jaspal, who will go through the main body of the presentation. Thank you.
Thanks. Thanks very much, Balázs. So indeed, everyone is talking about AI, and it could be very well the case that if 10 people talk about AI, that actually those 10 people mean 10 totally different things. And the reason for this can be seen on the chart on the left-hand side. As if you start once analyzing the term of AI, you will realize very quickly that AI is basically just an umbrella term, a very broad umbrella term, including various different subfields and different technological aspects. And exactly, so when people nowadays usually refer to AI, what they usually mean is generative AI. And what we so they usually refer to generative AI. So I mean, no doubt there has been quite a significant progress on the field of generative AI, but a large share of this significant progress can actually be traced back to the developments on the field of foundation models. And foundation models can be basically just seen as a knowledge base on which generative AI models rely on. So they process the knowledge coming out of foundation models in order to then produce the output. So this was one of our first challenges, namely to establish a common ground, a common understanding of what actually AI is, such that in the next step we can then discuss what the possible financial implications of AI could be. So generally, when we talk about AI in our work, we refer to foundation models, which, as you can see in the chart, then also includes automatically generative AI. And although AI has made significant progress, its cognitive limits should also be acknowledged. So the question still remains, is AI a stochastic parrot? I'm pretty sure some of you have already interacted with ChatGPT, and there are situations where the answers are so sophisticated that you could actually think that you're interacting with a human being. But in the end, the model per se just relies on probabilities. So depending on what your input to the model is, what the model does is it evaluates probabilities for different answers it could give you, and then just chooses the answer with the highest probability. Of course, when it comes to estimating the probability for those different answers, the probability this estimation can be improved by feeding more data, so training the model on more data or improving the quality of data on which it is trained. But in the end, ChatGPT or other large language models, they are not really able to understand the semantic meaning of language. But in the end, it's all about probabilities right now. And this one should also keep in mind. Then I will continue with the conceptual framework. And for the framework, we follow basically a bottom-up approach. So in order to understand what the financial stability implications are of AI, we first ask ourselves the question, what are the possible benefits and risks, not for the whole system, but actually on an individual institution level. Yeah? And those specific benefits and risks for individual institutions, they depend first of all on how those institutions use AI, and secondly also for what they use AI. And on this slide, I'm going to focus on the first factor, namely on how institutions use AI. And in order to do this in a structured way, what we present here is the so-called stylized development and deployment cycle of AI models, also shortly called D&D cycle. And in this D&D cycle, you can see that there are 3 steps, namely data, model, and deployment. And in each of those 3 steps, there are different challenges and opportunities associated to those 3 steps. And those challenges and opportunities, which are more from the technological perspective here, they are inherited throughout the use of the AI model. In combination with the final use case, you can in the end derive then specific benefits and risks at an institution level. For example, if we start now with the data, of course, the new generation AI models, they greatly enhance the processing capabilities and generation of data, but still they are prone to significant data quality issues. And those data quality issues, they could arise through a bias in the data poisoning, or simply just to the fact that you are relying on synthetic data, for example, to train your model. When it comes to the models itself, they are adaptable, flexible, and scalable, but there are still some issues which haven't been solved yet, and also not fully, they are yet not fully been understood why they appear. For example, hallucination is such issue. So hallucination is just the fact that a model gives you an output which is clearly wrong if you look at it, but the model still believes with a high level of confidence that it is correct. And why this kind of issue happens, it's still not clear. But this is of course also related to the greater complexity those models bring with them. And once such an AI model is deployed, then of course there is the possibility that it can increase efficiency, but the performance is difficult to predict, and of course it's also subject to possible misuse or over-reliance. To sum up on this slide, we can see different challenges and opportunities from a technological perspective associated with AI models and structured into 3 steps. But in order to come up now with specific benefits and risks for individual financial institutions, we also need to take into account for what financial institutions are actually using AI. So we identified 5 broad categories here. So you can see we have quantitative analysis here, operational processes, risk management, customer interaction, and cybersecurity. And by taking into account for what institutions are now using AI, and then analyzing this category with the 3 steps just mentioned on the previous slide, namely data, model, and deployment, we can then derive specific benefits and also risks. For example, if we focus now on the first category, namely quantitative analysis, just imagine an investment fund is relying on an AI model for asset price prediction. Now, of course, you have seen in the previous slide that when it comes to data with these new models, we are not only able to extract better information from data which we have been using already in the past, but now we are actually able to process more different kinds of data. For example, if you just think of unstructured data, which can be used very well with, or which large language models are using quite extensively. So this would be one specific benefit for this specific final use case. But of course, as already mentioned, AI does not only bring benefits, but also risks. And in this specific case, if just think back of the model and the deployment, you could still have a bias in the data, or there is this issue of hallucination. And all in all, this together, of course, these technological challenges, they reduce the robustness of predictions. And of course, this also has an effect on the performance of this investment fund if they rely on predictions which are made with AI. For the time being, we have identified those 5 very broad categories, as you can see, but our framework gives the scope that if in future institutions come up with new use cases which haven't been identified yet, we could just simply amend this table with this new use case and then just examine this new use case through the 3 steps which we have mentioned on the last slide, to then pin down what how the financial institution could then benefit, or what the risk for it would be coming or stemming from this new use case. So far we have been focusing on risk implications for individual firms, but those can have system-wide effects. And if they will have or will not have system-wide effects, this basically depends on 2 systemic amplifiers. The first one is technological penetration. So technological penetration is just how widespread how widespread is the use of artificial intelligence among institutions. And the second dimension here to mention is the supplier concentration. So not only when a lot of firms use AI, not only then systemic effects can appear, but also if the models which they rely on are similar due to a limited number of providers, systemic implications are very likely. The 2 charts here on this slide should just give you a feeling for where on those 2 systemic amplifying dimensions we are currently standing now. So on the left-hand side, you can see that there we analyzed the investments into AI startups. And you can see here very clearly that more than 50% of the investments into AI startups, they are concentrated among the top 4 companies. We do not argue that this is already like a clear indicator that we conclude that there is indeed a supplier concentration, but this is just this could be an indicator for it. And on the right-hand side, you can basically see the adoption rates of innovative technologies by banks. Here we can see that if you look to the column of AI, that more than 60% of European banks, they are already relying on AI technologies. But those AI technologies cover the traditional ways of using AI. So the most recent developments regarding generative AI, they are not yet captured in this plot here. But still, even without those most recent developments, more than 60% of banks in Europe are already relying on AI in their business. And so in future, if those two systemic amplifiers, so if a lot of firms, companies use AI, and in combination with a limited number of providers, if this happens to be the case in the future, then we can say, standing now in time, that there might be some financial stability risks, which could include, for example, stronger herding behavior. Because if a lot of institutions use the same models, then you can think of AI as a filter for how you process information, and then in the next step, of course, also impacting your decision making. So if a lot of institutions have basically the same filter on how they process the information, then this could result in a more similar decision making, which then could amplify herding behavior on financial markets. The second risk which could materialize is a high market concentration, because there might be some financial institutions which either miss the transition, this AI transition, or they're simply just not they're able to make the necessary investments in order to keep up with the transition. So it could be that some institutions drop back and then drop out of the market, and this could lead to higher market concentration, with also higher concerns are related to too big to fail externalities. And last but not least, also operational risk could materialize. Just think of banks, for example, for payment clearing. So if banks rely on other AI models for critical infrastructure, then this, of course, increases the risk of single point failure risk. And last but not least, we also identified cyber risk. Colleagues have prepared actually a box within our article, which is specifically only dedicated to cyber risk. And they argue that it's not only the frequency which could increase of cyber risk, but also the severeness of it. So to wrap up, AI may bring benefits both not only at the firm level, but also at the systemic level. But those systemic implications will very much depend on the level of the systemic amplifier. So how many institutions will use AI, and how the market of those AI models will develop in future, which is difficult to predict. But of course, we think it's that there is a need that we monitor the use and development on AI on financial markets. For the time being, we didn't identify any regulatory gaps, but of course, should in future concerns arise that cannot be tackled anymore by the current regulatory frameworks, then targeted initiatives may need to be considered. And with this, thanks very much.
Thanks, Jaspal. Thanks, Balázs. That really takes us into the future. We have some more time for questions, so please feel free to put them in the Q&A. Maybe you also want to share your own personal experience at your workplace with these questions. In the meantime, can you say a little bit more about what you mean with targeted initiatives? Do you have something concrete that you could envisage? So that's one. And the second thing, let me play a little bit devil's advocate. So on that last graph that you showed about the adoption rate of innovative technologies, the latest data comes from Q3 2022, which by AI standards is a lifetime ago, right? So that's not a criticism, but my worry is that all the information that we have on the use, by the time central banks or other government agencies or regulators start to look at it, may be so outdated. And how can you see some real-time monitoring, which we may need more than ever before because the cycle is just getting so fast?
Balázs, I cannot see.
Go ahead with the data, and I will continue with the targeted initiative.
Okay. Indeed, you're right. It's. I mean, when we say that we need to monitor the use of AI, then of course a necessary condition for that is to have the appropriate data. And we struggled actually also a bit when we were preparing this article to find really good data. And I think this is actually one of the main takeaways also for regulators to see that we need better data to monitor the use of AI. And also at the ECB, at the SSM, there are initiatives, colleagues are working on that. And there will also be a report on the use of AI in the close future. So there is already work going on that. And regarding a real-time monitoring, yeah, it's I think this will also just it will depend very much also on how the trends will develop in the future in general on AI. But I think it's difficult to give a final answer now on that. But yeah, data is important, and if we say we need to monitor, then of course we need a metric to look at. And but there are already initiatives going on at the SSM to get a picture, to get a better picture of that.
Thanks, Jaspal, and also just to address the first question. So those of you who follow the AI discussion more in detail may know that also at the European level, there is already a so-called Artificial Intelligence Act, which was adopted not that long ago. But this Artificial Intelligence Act is not very specific about financial stability issues. So, of course, on the basis of the impact assessment, we have this analytical framework. I believe that this will be used more frequently also by the ECB and also maybe market participants for the analytical purposes. We will then see whether in the future we may have to change something in the regulatory framework, either in the Artificial Intelligence Act, for example, amending it or some proposals. And also, you may know that there's also an ongoing vision of the macroprudential regulatory framework, the capital requirements regulation and directive. The Commission has launched a consultation on this, now preparing an assessment. So in the case we think we come to the conclusion, but on the basis of data and conclusions, so not just coming up ad hoc ideas, but on the basis of concrete experience, we may initiate something to be included in the prudential framework, regulatory framework, bank regulation, for example. But I don't want to preempt any future possible outcome of this assessment. I'm just thinking freely about possible ways of addressing this. At this stage, as also Jaspal mentioned, and made it very clear, there's nothing in the pipeline, but we keep an open eye on the possibilities.
We have a question in the Q&A, which is spot on. So Jeff Kutler asks, might there be a closer connection or nexus to be explored between the geopolitical and the AI stability risks? Is there a connection between geopolitical risks and AI? And let me actually add on, because that's something that was also on my mind, is basically the whole computing power underlying all the AI is located in the US. And so, if they switch off the lights there, we're doomed. I mean, all this is, even if we have still some startup in EU or there's something, the actual computing power, the infrastructure for all of this is in the US. So are we not becoming incredibly vulnerable to what's going on there?
I mean, I think this is one of the key points that also Jaspal mentioned when we talked about the concentration risk. And it's not only about the computing power, and you are fully right here, but also, for example, if you look at the chip industry, right, that produces the hardware, very much concentrated, for example, in Taiwan. Okay, so and this is one of the key geopolitical risks is the conflict between the US and China, and in the center is Taiwan and the chip production capacity there. So also from this perspective, I think it's fair to say that geopolitical risks are in some cases strongly linked to AI. But I believe this is also captured what we talked about concentration risk, but Jaspal may wish to comment.
Yes. So, I mean, I think this chart shows really nicely that, for example, those top 4 companies, you are indeed right that those are US-based companies. But I mean, those 4 startups are not the only participants on the market. Yeah. So, for example, if you look at Meta actually is also a big player in the AI market. And if I go back to the first slide, which Balázs presented, here you can actually see that if you look not only on where the headquarters of the companies are based, but if you now here actually look to the people working in the AI sector, here you can actually see that if you look at the headcount, that in Europe actually more people work in the AI sector, or Europe has more AI professionals than the United States. But I have to mention here that this is also related to the fact that, for example, talking about Meta has, for example, research labs also in Paris. So people are working in Europe, but partially also for companies which are, as you said, based or where the headquarters is in the US. So I would say Europe does not have to hide. Yeah. So we have smart people here.
But let me maybe follow up on this. We don't have the financing to get these things off the ground. All the financing action happens in the US. So maybe how would you see this? I mean, is this a problem for us? There's also a lot of talk about the capital market union in the report. I mean, I know that it's not precisely linked to your 2 special features, but haven't we? I mean, there are increasing returns to scale in all of this, right? The technology is incredibly scalable. I had been at a conference where one AI forscher just said, in Europe, we've missed the boat. That's it. No return back.
I don't know. Balázs, do you want to take this one?
Go ahead.
Okay. Yeah, I mean, it's still, I mean, you need to consider that we are still in the beginning of this transition, and I think it's just too early to say that Europe has already missed this boat. And I mean, there are some more general aspects, as you already mentioned, the capital market union, which of course also come into play here when we now talk about financing of AI companies. But I think this is a more general topic and not only, as you said, connected specifically to the development of AI. But yeah, I think full stop. Balázs, you may want to compliment.
Maybe just one point from my side. So, I mean, we also had quite lengthy discussions among ourselves. We discussed, talked about the future. And certainly at this stage, one can conclude that this is very concentrated, and maybe in the next 3-5 years, this will remain the case. But I mean, over time, as a new startup will be set up and start working, and I think it's a very dynamic environment, and I can imagine that 5 years from now, the world will look very different from this perspective, or 10 years from now, and then the same way as, let's say, technology was transferred to China and the East Asia in the last 20 years took place, it may also happen in the AI industry, and new companies may be established in different parts of the world, in Asia or in other or Europe. So I wouldn't conclude now that the boat has gone and that this is the end of the story. It may be true for the next few years. Yes, I agree. But in the longer term, I would be more cautious about this conclusion.
Okay, so with a positive outlook on this, as it's warrants from the ECB Financial Stability team. Thanks a lot, Jaspal, Balázs. Cosimo, our time is up.
Sorry.
And so I suggest that we close our webinar here now. Thanks a lot for being here, for giving for using us as a platform to talk about your really interesting special features. For anyone who wants to dig deeper, you can look at the Financial Stability Review. Let me finish by actually sending a link around where the ECB is doing a survey on the Financial Stability Review. So I presume with the view of getting, being even more on point and getting some feedback. So if you would like to do the surveys, I've just posted the link in the chat to everyone. So please take 5 minutes, or actually 3 minutes, as it says, and fill out that survey. I think the authors of the whole team would be very grateful for this. And with this, I wish you a great afternoon and the rest of the day. Bye-bye.
Thank you.
Very much.
Bye-bye.
Bye-bye.